Hi everyone, my name is piterpakulski. Today we're continue discussing very simple financial model from scratch. Today we'll be talking about the loan and the way it affects your business idea. So if you do have some business idea, you know almost nothing about Microsoft Excel, but you do need to calculate what will be the payback period, how much money you need to start the business, what will be the profit. So this video is for you. And the whole this playlist is for you, so you can build your own financial model from scratch, set up your inputs and see what will be the values of revenues, profits, payback period. And if you are taking a loan, you got to know how this loan affects your profits. So after you have your profits, then you have to pay the loan payment, and you got to know how stable your business idea, how the interest payments affect your profits. So for that purpose there is a specific coefficient which is called loan coverage ratio, and today I'll be going to show you how it's calculated. So I will copy the loan coverage ratio. So how it is calculated, very simple. So we are going back to cash flow statement. So for many valuable coefficients and ratios, we need our cash flow statement be done. So because we are taking the values from the cash flow statement for many of the coefficients and ratios. So what we are doing, we are taking the result from operating activity, which reflects your profit from the business itself. So result from operating activities, revenues minus direct expenses minus fixed expenses minus payroll minus taxes. So this is the way, this is the value that illustrates how your business breathes itself without any principal payments, without interest payment, without a loan. So and then you just divide this value, the result from operating activity, you're dividing by sum of principal payments and interest payments. So external burden from your bank. So then you press enter. So if this be an arrow, so we can divide by 0. So we will do if arrow, then we will place 0, because that's a ratio. I will do like this, then we will extrapolate this formula to the right. So let's look and see what these values tell us. So the loan coverage ratio must be more than 1. So for example, if this value is negative or less than 1, this illustrates us that our profit is sufficiently lower than we have to pay to the bank. So all we earn, we pay to the bank, and we have to pay. We need even to take the money from our pocket to add to pay to the bank. So that's why we need some extra financing here. And so if we have losses and we have payments for the bank, so that's why in this case this ratio will be negative. and that's bad. So this illustrates us that we need financing at this moment, and we earn sufficiently less than we have to pay to the bank, and even we even have losses here. So this case, when these values are negative, this illustrates that we have even losses in the result of operating activity. Here they are. Here these losses. If this value is positive but less than 1, this illustrates that we do have a profit, but this profit is sufficiently lower or simply lower than the amount of money that we have to pay to the bank. And we can see that this value starts growing as the business starts growing, and so here, somewhere here is a break-even point where the profit almost equals to the payments to the bank. So this is the 0 point. You can see that here. And from the next month, we can see that the profits start being higher than the amount of money that we pay to the bank. And from this moment, the ratio becomes more than 1. So if we go further, the bigger number of loan coverage ratio, the more stable your business idea is. So the loan coverage ratio must be A, positive, B, more than 1 at the moment when you have a loan. So at this time we have a loan, but if, for example, when the loan is over, like here, the ratio will equal to 0, because we don't have payments for the interest and principal payments. That's why this ratio will return to 0. But when we do have loan payments, your loan coverage ratio must be more than 1, and if it is 2, if the ratio equals to 2, 3 or 4, this means that your business idea is more and more stable. So if you just take your profits minus principal payments and interest payments, you will get more to put to your pocket as a final profit. So this is very valuable coefficient. So many people, when they have some business ideas, so as soon as they have their cash flow statement built, they calculate this ratio, and very often they face that their profits are just a little bit higher than the amount of payments to the bank, and they start rethinking their business concepts. For example, they don't want to take the amount of loan that they plan to take. They just want to consider taking smaller volume of loan, or they're trying to find some business partners or investors, so they are changing their business concept in the way they are going to finance their business. So this ratio tells the business owner a lot about the stability of his business idea, how the way he's going to finance his business idea going to affect his profits, when the profits occur, depending on the interest rate, the way the conditions of the loan that is taken. So that is very valuable and very interesting coefficient that may tell a lot to entrepreneur about his business idea. So maybe this video was useful for you. You may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. So see you guys in next videos. Thank you and bye.